Oh, right. Today is Monday, the 1st of January. Happy New Year. What happened to 2023? Who cares? It's gone now. This is a recap for the stock market activities last week and an outlook for the week to come, but it's also a discussion for 24. We're going to talk about the elections. We're going to talk about the Fed policy, the scenarios for the economy and the market, yada. And folks, I got a good one for you tonight, so stick with us here, grab an adult beverage, whatever you need, popcorn, and stay still. And again, whether you went crazy last night with the partying and you caught herpes, or you decided to stay at home, keep it low, and just stay at the couch, order some pizza, get drunk, get stoned, get shit-faced, and then pass out and wake up the next year. Of course, with the latter scenario, there are no consequences. You just wake up, okay, it's a new year. With the former scenario, well, you woke up with a little gift, New Year's gift that will remind you of that night over and over and over again. So Happy New Year. In either case, doesn't matter to me. What matters to me is what a year it was, 2023. Lots of surprises, defying expectations. A lot of crazy things happened when you look at the economy and the performance of the market, for example. We had the AI mania. We had collapse of regional banks. Major global banks such as Credit Suisse collapsed. Changes in Fed policy. Geopolitical events. Wars erupting all of a sudden. End of the year rate cut optimism by the Fed fueling a historic market rally. All of these things made 23 one for the books. But I believe that 23 was just the appetizer that will be forgotten. 24, on the other hand, will be the year to remember. It's going to be the year that's going to stun us all. Like I said, folks, we'll talk about the elections, the geopolitics, a lot of stuff. But we begin with the market here and the status of the economy, the scenarios that we have. What we know right now is we are at the end of the economic cycle. How do we know that? Well, the end of any economic cycle was always pretty much accompanied with a rise in inflation, a response by central banks that leads to a recession, and we see financial markets crashing, and we reset a new cycle and we begin all over again. The problem becomes in the road leading to the end of the cycle. That's the tricky part, and that's where we can be thrown off. For example, those of us who held a bearish view in the economy and the market, we got our asses handed back to us in the year 23. Why? Because heading into 23, by the end of 22, the assumption was, okay, we got inflation, now the central bank is responding, we get a lot of recessionary data, so we're going to head into a recession, economy goes down, market resets. Easy, isn't it? Well, it was not that easy. We had a lot of surprises along the way. For example, the data changed. At the end of 22, the assumption was that consumer savings will be depleted by the end of the year 23. Excess savings, that is. And that will be a mark of a recession. Because to eradicate inflation out of the economy, you need to reduce excess savings. All of those savings fueling spending in the economy have to be erased. Well, we got revisions to the data, and now we anticipate that that's not going to happen all the way till the end of 24. Not to mention, of course, the emergence of the AI mania, which added a market cap to 7 stacks, the so-called Magnificent Seven, worth about $12 trillion, which is triple Germany's GDP. Insane? Sure. But nobody had that on their bingo card heading into 23. While it was a year all in all when we saw corporate profits going negative, we have seen that the big cap technology stocks, as we covered in the previous video, managed to return into profitability again by cutting costs aggressively. That was among the unexpected heading into 23. Likewise, the increase of U.S. oil production was not expected heading into 23. We got that by the end of the third quarter. We saw a massive increase in U.S. oil production. Elections reasons? Sure. We'll talk about that in a second, but the rise of U.S. supplies led to a reduction in prices, while at the same time the impact of Federal Reserve interest rate hikes hasn't really been fully materialized in the economy. So we have seen a phenomenon of a reduction of inflation while economic growth remained holding, leading to the phenomenon that we call soft landing. Or some would call it the Goldilocks scenario. Now, the problem with that, of course, is soft landing never really happened. Goldilocks never really lasted. The soft landing phenomenon is a transitory phenomenon. We see inflation feeling the impact of interest rates by the Federal Reserve, but we don't see the impact of those interest rate hikes fully realized in the economy. And this is why we never had a soft landing. We talked about that in details in previous videos. But I believe that heading into 24, those who are holding a bullish view in the economy and the stock market are making the same mistake of the tunnel vision that the bears have held heading into 23. Now we see the bulls looking at the data that they have right now, assuming that that's going to be the lasting theme, not realizing the inevitable scenario of an end of any economic cycle, number one. Number two, the road that we will have heading into that. With that being said, we have to discuss all three scenarios, what supports them, because we will see a thematic shift in the economy and the stock market depending on the flow of the data. At one point, we're going to feel, okay, this is supportive of a soft landing. We feel pretty good now. Next thing you know, the data changes, or we get some reinflation in the economy, the mood sours, then we get another piece of data suggesting that we have recession creeping in. We're going to go back and forth, back and forth. And this is why it's important for us to understand these three scenarios, what supports them, and most importantly, how do we position our portfolios heading into 24? Because with the shift in these themes, right now we're mostly in the soft landing. Next thing you know, we have a reinflation risk. After that, we get a recession risk. Well, your positioning has to change. And this is why, at least in my portfolio, which I'm going to produce for my Discord members, we will have exposure to all themes, but we will begin shifting from one theme to another, depending on the data. So we're going to be more active. Investing in 24 will be more of an active investing year versus 23, which was a passive investing year. 23 was pretty much if you have the S&P or you parked at the big caps, you outperformed. Your retirement account probably outperformed your investment account because there was very little choosing you can do. I believe 24 will be different because of the changes in themes. So we're going to be more active than passive. With that being said, the challenge for 24 will be rate cut expectations. We know for the most part, absent of an abnormal event, that the hiking campaign by the Fed is over. Now the question becomes how fast, how frequent, and how aggressive rate cuts will be. It seems that we have a divergence of opinions here, specifically by the market and the Fed. The market anticipates rate cuts to happen as soon as March, and they will be really aggressive. At least 6 cuts in 24 alone, but with no economic weakness, with no recession risk at all. Rate cuts for the good reasons. Inflation going down while economic growth remains intact. The Federal Reserve and economists believe that, maybe we'll have rate cuts. Not as much as the market anticipates, and probably will be for the wrong reasons. It will probably be because we see the impact of Federal Reserve rate hikes on the economy, which will be negative for growth. To fix that, the Federal Reserve has to respond by reducing their interest rates slowly but surely. And hopefully that's going to happen with no accidents, with no recession. The battle of expectations will be pretty much the predominant theme in financial markets. The market will win if it gets what it wants, rate cuts, ASAP, for the good reasons. But if market expectations meet reality, and this reality is not favorable, meaning that either rate cuts will not happen as soon as the market anticipates, or they will happen for the wrong reasons, then the market will reverse all of the optimism that we ended 23 with and have a different look entirely. So again, let's discuss the 3 scenarios one by one, beginning with the soft landing, which supports the soft landing theory. Number 1, we talked about the increase of oil production in the United States. The supply is going high not because we're drilling more, but because we're pumping more out of existing rigs. Now, this could be political. Folks would say that the Biden administration is doing this for political reasons. It's going to be an election year. It doesn't matter. The impact is what matters. And the impact is we have seen gasoline prices at the pump going down. Well, when you have that, what does that do? If we have somebody in the economy who still has a job and now they have to spend less on gasoline, they have more disposable income in their pockets. They can use that to re-stimulate the economy. Likewise, the expectations of rate cuts are good enough to drop mortgage rates. This is how we see the impact right away. This is why the housing market is always a leading indicator. So we see mortgage rates dropping big from almost 8% to now about 6.5%. In the soft landing thesis, we see that the drop in 30-year mortgage rates combined with a low unemployment rate reigniting demand in housing. So we see buying of housing again, activities resuming in the housing market, realtors making money now again, rent rates are moving higher, folks are moving around, they're using U-Hauls, storage facilities, they're spending on gasoline, they're renting cars, they're buying new homes, they're getting new loans. All of this stimulates new activities in the economy. That's the assumption, of course, that rate cuts, as we see right here, the impact in mortgage rates will be stimulative in the economy. Furthermore, what supports the soft landing theory is, what if rate hikes don't have that much of an impact as we've seen before. Meaning, sure, the Fed can raise rates, and this is going to impact the rate of new loans, of credit cards, of student loans, but not going to impact folks who are already in their homes. They own their homes. They got their fixed mortgages a while ago with lower interest rates. How are they going to be impacted with higher rates by the Fed anyways? And those folks were not impacted. Now they have more savings in their pockets because they used that money. They put it in a savings account with a higher rate. They bought maybe a T-bill, maybe in a money market fund, and now their wealth has increased. In other words, interest rate hikes was actually good for them, not bad. And now as we see mortgage rates going down and housing activities freeing up more and more capital, we see these folks, homeowners, at lower mortgage rates, using their money, spending in the economy again, and re-stimulating growth into the economy. And hence we have soft landing. But of course, the soft landing theory would not be valid if the unemployment rate rises. Well, for now, we're not seeing any of that. What we're seeing is the rate of job creation slowing down, which is less inflationary. Okay, so if we still have jobs being created and folks still have their jobs, their savings have improved by higher rates, and now we see lower gasoline prices and lower mortgage rates, wouldn't this combination of all of these elements lead to more spending in the economy, which will lead to the resumption of stimulation of growth into the economy? This pushes the risk of a recession away, and if we don't see inflation coming back, then mission accomplished. We got a soft landing. So the soft landing theory has supporting evidence right now. The problem is if the resumption of growth leads to reinflation, and this is where the second scenario comes. Reminder, the leading indicators, housing and energy prices. Why? They respond more. They respond to the expectations of changes in the monetary policy. They don't wait for the change to happen before they kick in. So when you hear the talk about lags, when the Fed raises rates, there are lags. That happens for refinancing. That happens for new loans issuance, paying back debt. But there are also leading indicators before the Fed raises or cut rates. Those are housing and energy prices. We just talked about how expectations of rate cuts have dropped mortgage rates dramatically. With that, we see the resumption of activities in the housing market. The resumption of activities in the housing market could lead to an increase in pricing, and that's inflationary. The headline reads, October home prices post biggest gain of 23 despite higher mortgage rates, according to S&P Case-Shiller Index. That's the problem. We don't want to see home prices going higher again. We want to see home prices going down. Well, the problem is if you have re-stimulation in the economy and the restoration of purchasing power, then wouldn't that increase the demand for housing and push prices higher again? This is the problem that could lead to a reinflation phenomenon in the economy. Likewise, when we look at gasoline prices, they've been dropping down. But recently, in the last few weeks, as the Fed announced that yes, they see rate cuts too in 24. Not as much as the market anticipates, but sure, we see them. The reaction to that was short covering in oil commodities and interest in buying those energy commodities. Why? Because the dollar went down. If you're going to devalue the dollar with expectations of rate cuts by the Fed, then demand for energy, demand for crude oil goes higher. For now, gasoline prices are low, relatively speaking, at least to 22, 21. But the fear is that if the Federal Reserve cuts rates indeed, are we going to see a phenomenon such as the ones we've seen back in the year 2008? When we've seen volatility in energy prices as we fluctuated from soft landing, recession expectations, reinflation. And then when the Fed finally cut rates in September of 2007, we have seen a resurgence in energy prices, and oil prices shot up significantly higher, leading to higher prices at the pump for the consumer. And that was one of the factors that led to the recession. Are we going to see that in 24? That's the risk of reinflation. It's not here now, but it is a possibility. As we see more devaluation of the dollar and we see rate cut expectations being amplified, that leads to expectation of regrowth in the economy, and with that, demand for gasoline. Another supporting evidence for the reinflation outcome is China. China has been weak. Heading into 23, we all anticipated that, China is going to reopen. Well, China reopened, but we haven't seen demand by China resuming. Demand was really weak, and it remains weak. Question now becomes, what if the Chinese government decides to issue a stimulus? If they do that, well, stimulus leads to stimulation of growth. stimulation of demand in the Chinese economy, which means more demand for commodities. So when we talk about a supportive evidence of the soft landing theory is lower gasoline prices, well, we see already that not only supply has increased above expectations from U.S. producers, but global demand for oil is also increasing above previous expectations. It's a no-brainer. If we have demand exceeding supply, prices go higher. If we have, as we do right now in the oil market, supply exceeding demand by a little bit, we see pricing going down. If China issues a stimulus, demand for oil will increase, while the supply, we see a rise in supply from U.S. production, but Saudi, Russian, OPEC production is down. That could tip the balance in favor of demand versus supply in the oil market, not to mention the geopolitics, of course, and that leads to reinflation in the economy. The recent devaluation of the dollar alone has led to the prices of many commodities to rise higher, specifically metals. If you see the prices of iron ore, for example, they've been moving higher, as anticipation of rate cuts lead to the devaluation of the dollar. You combine that with Chinese stimulus and resumption of demand by China, you will see the prices of these metals skyrocketing, and that would be inflationary for the economy. When we talk about the devaluation of the dollar, the challenge becomes the synchrony between central banks. So far, they haven't been at conflict yet, even though we talked about this theme in numerous videos in this channel before, that at some point the Federal Reserve will be against the ECB, against the Bank of Japan. All of them will collide together because of the currency war. If the Fed decides to cut rates, that's going to devalue the dollar. Okay, what is that going to do to, let's say, the euro? The value of the euro will go higher, which reduces the rate of domestic inflation. It increases the purchasing power for European consumers, sure. So we could see services inflation receding, going down by a little bit. But then commodities inflation, that is tied to the dollar. If the value of the dollar goes down, then prices for commodities will go higher, including energy. And that's going to lead to reinflation in the headline inflation rate. So now if we look at the ECB projections here, it reads that euro area inflation probably reversed course in December. Why? Because of the devaluation of the US dollar. So you see that headline inflation in blue, the expectations are this is going to rebound higher in Europe. But the rate of core inflation, the line in yellow, will probably continue to go down little by little by little, be at a slower pace here. That's all because of the devaluation of the US dollar. Now, it's going to be worse for the US consumer because not only we're going to see the reinflation in commodities prices because of the devaluation of the dollar, but also the purchasing power for the US consumer will go down. And that could lead not just to reinflation in the economy, but also a stagflation phenomenon. So now that we talked about the soft landing risk, and the supporting evidence, the reinflation risk and supportive evidence, let's go back and talk about the recession risk and its supportive evidence that we have here. We begin with, what about regional banks? What about Silicon Valley? That bank collapsed, then came First Republic banks and many other banks that blew up. Is that over now? Not really. The Federal Reserve decided to place a band-aid on top of that, and it worked for now, but that's only kicking the can down the road. At some point, all of these lending facilities will have to be over. And all of these regional banks and not so regional banks who are continuing to borrow money from the Fed at a higher rate, they have to pay it back at some point. Do they have the liquidity to pay it back? That's going to be a problem. Not to mention, of course, the fact that the unrealized losses for these banks from the bond positioning alone is huge. While we see that bond yields went down and bond pricing improved a little bit, it's not enough to cover for all of these unrealized losses in the bond positioning and fixed income positioning by these banks. They need to have rates going down to zero. Otherwise, they're going to have to face this problem sooner than later. And continuing to lend from the Fed is problematic by itself because a lot of you would say, hey, Maverick, all of these losses in the balance sheet for banks don't matter because whatever exodus in deposits that they're going to cause, the Federal Reserve will lend these banks money. And how are you going to beat that? Well, understand that now they have interest rate liability on top of their unrealized losses. Things are not getting better for regional banks, and you're going to need re-stimulation of growth in the economy by a lot and a reduction of interest rates down close to zero to stop the bleeding in deposit exodus, improve these unrealized losses on the balance sheet for banks, and resume their revenue growth by re-stimulating loan demand in the economy. A lot of things need to happen to prevent the blow-up of regional banks and many other banks, not to mention, of course, all of their bad loans that most of us who are not working at those banks, who don't have that kind of information, have no idea about. Those bad loans will have to be refinanced at a higher rate. What if these banks continue to eat more and more losses in these loans? The systemic risk of a blow-up in one of these banks supports a recession scenario as we've seen back in the year 2008. Another supporting evidence for the recession scenario, but honestly, the stagflation scenario, is the issuance of bonds, T-bills, by the Treasury Department. We know that the issuance has been increasing because of the fiscal spending and the fiscal needs of this country. Now, you and I might have different political views. I think that we have excessive spending in the economy. You might think it's a necessity. It doesn't matter at the end of the day. You can either finance it by increasing taxes, or you can continue to issue more and more debt. The problem is, in the past, the Federal Reserve was the buyer of all of this issuance of bonds, so it didn't matter if we have a deficit, didn't matter if we spent beyond our means. The Fed was assuming the buying of those issuance. Now the Fed is in quantitative tightening, not quantitative easing. Now the Fed is dumping bonds, not buying them. At least they're trying to dump their bonds, without causing a disaster, because if we have the Treasury Department along with the Fed dumping bonds together, we have a blow-up coming. So we have seen this year a coordination by the Fed and the Treasury Department. In the beginning of the year, the Fed was indeed doing quantitative tightening and dumping bonds. Then came the deluge by the Treasury, issuing bonds. The Fed backed off a little bit, and there was somewhat of a balance here. And it did not lead to a huge increase in interest rates or bond rates. We've seen some of that in Q3. The 10-year yield blasted higher to 5%, causing problems in the equities market. But after that, the Treasury Department came out and said, okay, we're going to reduce the deluge here all the way till 24. And then the inflation data came out soft, and a lot of folks said, okay, now the Fed will not have to be aggressive in quantitative tightening, and they might reduce rates themselves. So we've seen rates in the 10-year bond going down. But like everything in this economy, we're just kicking the can down the road. At some point, the Fed and the Treasury Department will have to collide. The Fed has to reduce their balance sheet. At the same time, if the fiscal spending continues to go on in an election year, who's going to finance all of this spending? We have to issue more bonds. And the problem here is the issuance of more bonds, more supply, no demand. What's that going to do? Bond prices will go down again, and we will see the rates on those bonds moving higher. That would be the equivalent of financial conditions tightening in the economy again. You see, what led to the stock market rally in the fourth quarter was the loosening of financial conditions. Because rates on bonds went down and expectations of Federal Reserve rate cuts went higher, the combination of both led to loosening of financial conditions and led to a rally in the equities market. This dynamic could change. If Janet Yellen can dump more bonds in 24 to increase fiscal spending and cover for the deficit, the question becomes, can the Federal Reserve just continue to hold in their quantitative tightening operation? Or will the Fed also join the Treasury to dump bonds, which will lead to skyrocketing rates on bonds because the demand will never meet the supply? Foreign buyers will not cover for the huge supply in bonds. Likewise, if the banks are forced to buy these bonds, then the banks will have less liquidity to stimulate the economy, and that's recessionary. And that leads us to another supportive evidence of the recession outlook for the economy: tightening lending conditions. The headline reads, U.S. consumers will soon wake up to out-of-control interest on their credit cards, economists say. What are they talking about? The rate on your credit card loan increased, and you had to spend more using your credit card because inflation went higher. Your wages didn't really catch up with the rate of inflation. Now you have an enormous amount of debt. Can you pay back this debt at a higher rate? And if you can't, then we see the delinquency rate on credit card loans increasing. If you look at the percentage change from a year ago, delinquency rates have exploded higher. That is a sign of stress on the economy and consumer spending, and if the consumer is squeezed and choked by higher rates and the debt that they've already accumulated, how are they going to stimulate the economy? Rate cuts or no rate cuts? The debt has already incurred. They have to pay it back before they can stimulate growth and spending in the economy. So that supports the recession outlook of the economy. We'll look at the delinquency rates for all loans, not just credit card loans, all commercial banks. We're now moving higher. Not as high as the recession in 2009, but again, in 2006, 2007, we've seen a rise in delinquencies. It was a no biggie. It was not an explosion in delinquency rates until it happened. These things happen really, really fast. Now we're trending higher, not lower. And that increases the recession probability in the economy. Likewise, tightening standards for loans by commercial banks for small firms, meaning small businesses in the economy, the core and the heart of this economy. If these standards are increasing, then we have tightening of these conditions. It's not easy to access a loan as a small business. What's that going to do? It's going to lead to less spending in the economy, less hiring in the economy, and that supports a recession outlook. Now, we have seen that standards loosened a little bit as of late. Would that be enough? Would that be a beginning of the trend of lending standards improving, or are we going to see them tightening again as rate cut expectations by the Fed are pushed further down the line? And it is a similar look for tightening standards by banks to large and middle market firms. We see that standards are really tight right now. That's recessionary. That's going to slow down the economy. We've seen an improvement as of late. Will that last or reverse? If it reverses, and we see standards being tightened even more because of pushing rate expectation further down the line, or because banks have to spend their money buying bonds instead of issuing new loans, then standards will tighten even more, and that supports a recession in the economy. Recently, we have gotten the Chicago Business Barometer, and it reversed down in the month of December to a rating of 46.9. Now, in the month of November, the reading was 55.8, so this is a sharp drop in the month of December. That also supports a recession outlook. Recently, we have heard from many retailers saying that demand is going down. We're not seeing consumers spending as we used to before. Consumers are waiting for deals and discounts, which reduces the pricing power of these retailers, which means less margins. It's not just a story for retailers. Recently, we've heard from airlines, FedEx, Nike, all of them warning that, hey, we're losing our pricing power here because consumer demand is weakening, which means less profits, less margins. And oh, by the way, worst case scenario is if consumer demand continues to be weak. But we see a resurgence of inflation in gasoline prices, for example. Now, that's an additional cost to us, businesses, not just the consumer. But we can't remedy that by increasing prices anymore, meaning that corporate margins will continue to be reduced. That's recessionary. A leading indicator to that is the data that we got from China recently. China factory activities post the worst contraction in 6 months. Well, gee, if the economy was about to improve and consumer demand to be resumed, then businesses will be replenishing their inventories. We should be seeing factory data from China improving, not contracting. So the evidence here is recessionary, not pointing to a soft landing or even reinflation in the economy. And the last supporting evidence for the recession outlook for the economy is what happens overseas. What if the systemic risk is not here? We talked about regional banks. We talked about commercial real estate before in details in this program. What if the blow-up comes from a war scenario overseas? What worries me is the UK economy. They still have a really high inflation rate. It's been dropping, but it's still way higher than the US. At the same time, we see the UK economy shrinking, meaning that we have somewhat of a stagflation phenomenon in the UK. Recession meets sticky, higher inflation. What if that combination, regardless of what the Fed does to the US dollar? Of course, it will be worse if the US dollar is devalued, but what if the dynamic in the UK leads to a blow-up of a major lender, a major bank? And that leads to the beginning of a contagion impact, not just in Europe, but globally. Well, that's going to be recessionary. That's the blind spot in the mirror that nobody's paying attention to right now. Anyhow, now that we talked about the 3 possible outlooks here and outcomes for the economy, soft landing, reinflation, and a recession, discussing the supporting evidence for each scenario. The question now becomes, how will the Fed respond either way? Because that's what we really care about. The response by the Fed is what really matters in determining whether we go into a recession or reinflation or a soft landing. And before discussing these scenarios by the Fed, we got a lot of questions about what happened recently in the repo facilities. For example, the inflows into the reverse repo facility hit over $1 trillion. The expectations were for $800 billion. So there's a huge inflow into the reverse repo facility. All of a sudden, by the end of the year, we have volatility back into the repo facility. Is that a problem? We see the SOFR rate rising to all-time highs, 5.40%. This is the secured overnight financing rate. Is that problematic? Now, we know that by the end of the year, a lot of books are being closed by banks. So it is not unusual to see big inflows, not as big as we've seen, but big inflows into repo facilities, specifically the reverse repo facility, and we see that the SOFR rate rising higher. This is not unusual. The problem is if it leads to a phenomenon such as the repo crisis that we got back in 2019, when the SOFR rate exploded higher. We see it moving higher right now. If it doesn't stabilize as we enter the new year, we could see a repo crisis again, the likes of 2019. What if that leads the Fed to initiate a preemptive rate cut? Because if that happens, we will see the stock market going down, we will see rates going higher, so the Fed will have to respond by doing a preemptive rate cut. That will increase the risk of reinflation in the economy. So if you see that happening, the dollar is going to be devalued by a lot, and the move by investors should be buying metals, gold, silver, steel, iron, copper, palladium, platinum, Any metal would do pretty good under these circumstances. But absent of that, we are right now in the calm before the storm. We are right now in the assumption of a soft landing, Goldilocks, whatever we want to call it. But historically speaking, we know that this is a transitory phenomenon. Sooner than later, you face the duality of the risk. We talked about this in details in this program. The risk of reinflation or the risk of a recession. What would the Fed do based on each scenario? Really matters. In the case of reinflation, suppose that we get data this month, in the month of January, showing us that retail sales exploded higher in the month of December. The jobs report showing an explosion of hiring again. Job openings moving higher all of a sudden. The CPI, specifically core CPI, coming out higher. It moves from 4% to 4.1, 4.2. All of this would ruin the interest rate cut optimism party. How would the Fed respond, though? We have two possible outcomes. Either they're going to hold rates, meaning that interest rate expectations for a March rate cut will be pushed further down the line. Maybe now we'll have to talk about June or even the third or fourth quarters of 24, even 25. The other outcome would be a hike by the Fed. Now, we don't think that a hike will be necessary here, absent of something really abnormal. Say a huge geopolitical event, then the Fed will have to hike rates. But absent of that, the most likely scenario would be a hold. What will a hold do? Higher for longer. We go back to higher for longer. The stock market will decline, and we will see the recession risk increasing. In the case of a hike, and again, we don't think that's going to happen, but if it does, it will lead to a stock market crash and the increase of a systemic risk in the economy, because rates are already relatively high as we speak. You add more to that, you're going to increase the risk of something blowing up. Now, suppose that we don't see what a lot of folks are anticipating, which is the resumption of demand and spending in the economy. What we get instead is more recession data that, oh, wait a minute here, inflation is actually going down for the wrong reasons. Well, if that is the case, then what will the Fed do? There is only one possible outcome, which is a cut. And this is why the recession risk doesn't scare the stock market as much as the reinflation risk. Because in the market psychology, okay, if we get a recession risk, so what? The Fed will respond by cutting rates, and that's going to fix it. The Fed now has plenty of ammo, 500 basis points, all the way till zero. So we're not scared from the recession risk right now until the shit hits the fan. Now, there are three possible outcomes if the Fed indeed cut rates in response to recessionary pieces of data. So if we get, for example, the jobs report this Friday, and it shows a contraction in job creation, an increase in the unemployment rate, the revisions for previously issued jobs report say, oh, wait a minute here, we've actually created less jobs than before. We're actually losing jobs in certain sectors. If that is the case, the Fed is going to cut rates. And the risk from that is, if it is done a little too soon, meaning we're not seeing significant damage in the economy yet, just a little bit. Other classes of the consumer are still doing good. We're not seeing, let's say, major layoffs. This is going to lead to the reinflation risk. It's the same thing we've seen back in 2007, 2008. The Fed cuts rates. We see a stock market recovery. It moves higher, but it's led by commodities. We see a rise in commodities because of the devaluation of the dollar. Now, as we discussed before this segment began, if we have a systemic risk that causes the cut, such as a problem in the repo facilities or a blow-up of a regional bank, or a major financial firm overseas, then the Fed cuts rates for the wrong reasons. What's going to happen is the Fed will continue to increase the pace of rate cuts. Usually that's not good. When they go from 25 to 50, they do that for the wrong reasons, and we see deeper stock market losses. At that point, the economy will already be in a recession. If you recall in not the previous video, but the video before that in the intro, I shared with you the piece of news from CBS back in 2008 after the collapse of Lehman Brothers, when the anchor said, oh, we're now officially in a recession. Economists say that the recession actually began a year ago. Nobody noticed. They're going to say the same thing here. The systemic risk will be just the confirmation that, yeah, we've been in a recession. Now we're cutting rates for the wrong reasons. Here's the bullish scenario that supports the soft landing thesis. If the Federal Reserve indeed gets a recessionary piece of data, they decide to cut rates based on that. It's the modest regrowth scenario, meaning that rates are still going to be higher, not as high as they are right now, but higher than zero, which will be restrictive to some part of the consumer base, but also stimulative to other base, maybe the more affluent consumer, the upper mid class. And that leads to a balance. You have a part of the consumer that is spending, another part that is not spending as much. And you don't get a reinflation risk because of that. What is that going to do? It's going to lead to moderate stock market gains. And probably in that scenario, you're going to have to be really, really picky. It's going to be certain stocks that will outperform. versus others. And the assumption is the big caps will continue to do fine due to their exposure to corporate spending and affluent consumer spending. With that being said, the heydays of the year 23, for example, when we got huge stock market gains that got us back to the highs from 21, you're not going to see that again. You're also not going to see a year like 21 or 2020 when we've seen huge growth in the stock market because these were stimulative years. So these are the possible reactions by the Fed, depending on the scenario, and how they will impact the outlook for the stock market and the economy. Now, we can't talk about the year 24 without talking about the elections. It's going to be all about the elections. And we have seen, of course, if you look at CNBC or the Wall Street Journal, what they say is a piece of statistics that they give to us as managers. Back when I used to do the job, they'll give you a sheet with all of the statistics. And again, it's a trick. It's a game. Most of these stock market statistics are positive because the stock market goes higher over time. The market gets rid of bad companies, replace them with good companies. We see inflows from retirees, retirement accounts continuously. So the market over time goes higher. This is why the statistics are usually tilted bullish. So when a client calls us and says, okay, I'm really scared right now, things are not looking good, please take my money. Stick it into a bond or a safer investment vehicle. We grab the sheet and say, no, but look, if the market gained 3 months in a row, it means that the next year will be great. That's what the statistics say. You got to stay in the market here, buddy. Of course, the statistics say that election years are mostly positive, not negative. So if somebody's scared because of elections, we say, hey, look, the statistics here say that elections years are usually positive, not negative. But understand that the statistics are biased. If you look at the year 2008, for example, elections year, Obama, change is coming. The stock market crashed. If you look at election year 2016, it was volatile, it was positive, but it was really volatile because of the possibility of Trump becoming president. In the year 2020, Joe Biden winning the elections, it was a really good year for the stock market. So we have variety of outlooks and outcomes here. You can't say because we have an election year, it's going to be good for the stock market. Each year is unique. Each year has its own challenges. And in the year 24, I believe that we're going to see the conflict between the Federal Reserve and the White House. Jerome Powell, chairman of the Fed, and President Joe Biden, both of them have different goals in a critical year. Jerome Powell, chairman of the Fed, he has his own goals. He cares about his own legacy. He wants to be seen as Chairman Volcker, not only the guy who defeated inflation, but better than that, the guy who delivered a soft landing. At the same time, his biggest fear is ending up being remembered as the worst Fed chairman in history, surpassing Arthur Burns from the 1970s, who dismissed the risk of reinflation, and we've seen reinflation like you've never seen before. So Chairman Powell, maybe he wants to be positive. Maybe he wants to please the market. Maybe he wants to do political favors to the Biden administration. But at the end of the day, Chairman Powell cares about himself and the legacy of the Fed more than anything. And that could lead to a conflict between the Fed and the White House. The two possible outcomes, as we said before, it's a cut or a hold. We see a hike, but that's going to only happen under an abnormal scenario. Chairman Powell has two choices, cut or hold. Of course, the cut has its own timeline. Is it going to happen sooner or later? To the market, the sooner the better. To the White House, maybe they think sooner the better. The problem is, what if the Federal Reserve cut rates and then we see reinflation risk increasing? What's good right now for the Biden administration? Gasoline prices down. What if the Fed cuts rates and we see gasoline prices coming back up? The Biden administration will not be pleased. What if the Federal Reserve decides to say, you know what, we're seeing a lot of risk of reinflation here. We're not seeing inflation coming down to the target soon enough, so we're going to hold rates here. What is that going to do? Increase the recession risk. Is that going to be good for Biden or bad? White House is not going to like that. So it is pretty much mission impossible to please the White House by the Federal Reserve. Damned if you do, damned if you don't. If you cut rates and we have risk of reinflation, White House loses. If you hold rates higher and we see a recession risk in the economy, and then the Fed cuts rates a little too late for the White House, well, that's not good for Biden. Will the president then blame Chairman of the Fed Powell? Will he blame the Federal Reserve? Because it is impossible to please Biden at this point. Biden wants his cake and eat it too. He doesn't want reinflation. He wants inflation to be low. At the same time, he wants rates to be low because the voters are complaining about both. They complain about higher rates and higher inflation. How do you relieve both at the same time? You can't do both. It requires a miracle. So I think that we're going to see these two men colliding here. If it is not publicly, it is behind the scenes. But Joe Biden has a weapon here to influence Powell, and that weapon is called Janet Yellen. You see, she's the former boss of Jerome Powell. And for some reason, for some weird reason, Jerome Powell is really submissive to Janet Yellen. He thinks that everything comes out of her mouth is gold. Everything she says, everything she advised him to do is the gospel. And will Biden here deploy Janet Yellen to influence Powell? Which way, though? Cut rates sooner, risk reinflation, or hold rates? Maybe cut rates, then inflation comes back, then you gotta raise rates again to reduce the inflation risk? It is a mess, ladies and gentlemen. And we see that the Biden administration now beginning to shift their tone into the economy more than other things. Bidenomics, Jack. Why Bidenomics? This was not the original plan, by the way. The original plan was that Joe Biden is going to run his re-election campaign on foreign policy. He's the man who restored America's stance in the world. Everybody respects us again. Well, that's not working so far. It actually turns out to be a disaster. So plan B for the Biden administration is the economy. And as we see the Goldilocks scenario emerging, at least for now, the Biden administration wants to go and talk about the economy more than anything else heading into 24. Few months ago, when oil prices were rising higher, when gasoline prices were going higher, Bidenomics was not working. Now it has more appeal. Perhaps it explains why Joe Biden decided to do a closed-door deal with energy producers here in the U.S. to pump until the elections. Because the campaign strategy of focusing on foreign policy was proving to be disastrous. And I believe that the concentration now, the refocus into the economic policy will be even more disastrous for the Biden administration. We'll talk about both. We already talked about the challenges with the economic focus. We'll talk about the foreign policy and the geopolitics risk here in a minute. But we have a problem with the polls. They're absolutely horrendous for President Biden. The headline from Politico reads, "What is behind Biden's sliding poll numbers? Question mark. I look at Joey B here. He's like, what am I looking at here, Jack? Where's President Barack Obama?" And he's going to be even more confused than ever before. Because here's the problem with the foreign policy. The original plan now scrambled because Joe Biden has two problems. Problem number one, Putin of Russia. Problem number two, Netanyahu of Israel. The war in Ukraine, of course, did not go as planned, and we warned you in this channel repeatedly. It's going to be a disaster, and we, not the Russian, we need an exit plan here. A lot of you said, Maverick, you don't know what you're talking about. You're a puppet for Putin. Well, what do you got to say now? Because everything we talked about regarding the conflict between Russia and Ukraine is now coming true. The Russians are winning. There's no doubt about it. So what do you do here if you're the White House? Re-Russia Ukraine. You got three options. Status quo, Biden escalating, or Putin escalating. If you leave it as the status quo, here's the headline from the New York Times. Russia retakes some land hard won by Ukraine during the counteroffensive, which was an absolute failure. How much did we spend on that counteroffensive? 50 billion, 60 billion? U.S. taxpayer money, and nothing happened. Shit. Zero. Financial Times says, what if Russia wins? Question mark. Well, according to The Economist, which is a media operation for British intelligence, they never talk about the economy really. They talk about geopolitics all the time. Now they say that Putin seems to be winning the war in Ukraine. For now, they say, but they're admitting that Putin is winning. So leaving it as the status quo is disastrous for the Biden administration. That's not a choice. Now, you might say, but Maverick, why are we talking about the geopolitics right now? They're gonna impact the economy, the market, Jack. Whatever happens in the geopolitics will have an enormous impact on commodities and investors' response to the stock market. So we have to talk about scenario number two. If leaving it to the status quo right now is not good. What if Biden escalates? What if Biden says, okay, I gotta stop Putin here. I gotta stop him from having a win before the re-election. What are you gonna do at this point? You can't secure funding for Ukraine to fight anymore. Ukraine is running out of men. The counteroffensive failed, so what do you do at this point? Hire the Polish to do the job? Sending American troops? Risking a nuclear war? That's crazy. The other scenario is, what if Putin escalates? What if Putin now, because we're talking about, maybe now we need a peace deal with Russia. And Putin says, no thanks, not interested. Why? Because he's winning now. And he can actually cost Biden the elections by sticking that knife in the back and twisting the knife by escalating more and more and more. And this is what Putin is doing right now.
Russian leader Vladimir Putin said moments ago that Russia will increase its airstrikes on Ukraine in the coming days, weeks, and months. This comes as Ukraine says that Odessa, on the Black Sea coast came under assault from unmanned Russian drones.
So Politico says that the Biden administration is quietly shifting its strategy in Ukraine. For 2 years, Biden and Zelensky have been focusing on driving Russia from Ukraine. Now Washington is discussing a move to a more defensive posture. What does that mean? It means, sure, let Putin go ahead and twist that knife and bomb more and invade more and take more land. We're just going to defend here and use that as a strategy, re-election strategy, to say, you know what you people are seeing in Ukraine right now and Putin winning is a result of the Republicans stopping all of the funding and the weapons and the money that we needed to send to Ukraine to defeat Putin. That's on the Republicans. That's why Putin is winning right now. And that's the only possible scenario right now that Biden can use in this disastrous war in Ukraine that we pretty much lost as of right now. That leads us to the other problem, which is Bibi Netanyahu of Israel. That came out of the blue, by the way. When it rains, it pours in the Biden administration. They were preparing a win in Ukraine to say, look, voters, we defeated Putin. We restored America's stance and power in the world. You got to stick with Biden here. You got to stick with the Democrats. Trump is going to turn the world loose again. America's not going to lead anymore. Rogue regimes and leaders like Putin and Xi Jinping and Iran will run haywire across the world. You need America's leadership. Well, you can't do that anymore because we're losing the war in Ukraine. And then all of a sudden comes the war in the Middle East. And we have in Benjamin Netanyahu, the Prime Minister of Israel, a man that was politically chased. He was going to end up in a prison anyways. Then came October 7th, and he found an exit door and saying, you know what? You got to forget about your hatred for me here. We got to be all united to punish the enemy. And he bought himself more time. But now, if the war stops, his political career is over. So it is in his interest to prolong this war as much as possible, not just prolong, but expand the war even more. What is the problem with that? He wants to clean house. He wants to deal with all of Israel's enemies, not just Hamas, but Hezbollah, Iran, Yemen, and even if it takes Egypt, Jordan, doesn't matter. Anybody. The expansion of the war, the involvement of the U.S. means distractions from Netanyahu's personal problems. Why is that a problem for the Biden administration? Why would we see a collide between these two men? Well, number one, the U.S. voter has no appetite at all to go into a new war right now. Headline reads, it is becoming clear Israel could cost Joe Biden re-election. What are they talking about? On one hand, if Joe Biden appears to be weak and not supporting Israel enough, that's going to open the path for Republicans, be it Trump, be it DeSantis, be it Haley, be it anybody, to say, okay, Biden now is not supporting Israel as we're supposed to. And this is why we see the Biden administration in a tight spot here. On one hand, they have to keep the look that they're supporting Israel enough. So we see the Biden administration bypassing Congress again to send weapons to Israel. On the other hand, there's another part of the population, of the voters, who absolutely disapprove of Biden's handling of the Middle East war. According to the latest poll, do you approve of President Biden's handling of the Israel-Palestinian conflict? 57% disapprove. The other question is, who do you trust to do a better job on the Israel-Palestinian conflict? 46% say Trump, only 38% say Biden. This is a major, major problem. You can see the divide here. Among Democrats, 34% say that we're more empathetic to the Palestinians, not to the Israelis. Among black voters, perhaps one of the most important part of the Biden coalition, 34% say we're supportive of the Palestinians, not the Israelis. When it comes to age, younger voters, in the dispute between Israel and the Palestinians, which side do you sympathize with more? Younger voters, 18 to 29, 46% say Palestinians, not Israelis. Well, that's going to put the Biden administration in a big problem here. If you don't support Israel enough, you're going to piss off the older voters. If you do that and you support Israel, you're going to piss off your own coalition, which include black and younger voters, the Democratic base. And the other problem, of course, is we can't go around the world and say, hey, look at Putin. Putin the devil. He's bombing and killing people while we have our ally in Netanyahu bombing and killing people too. So the tweet by Secretary Blinken, of course, was met with ridicule here. He says the U.S. strongly condemns Russia's horrific attack or strikes against Ukraine today. And folks are saying, well, what about your guy in Israel? He's doing the same. Do you condemn that too, Mr. Blinken? There's no answer to that. It's embarrassing. So we want to move from this Middle East conflict ASAP. And the question now becomes, if Blinken or Biden or anybody manages to contain Netanyahu and pull him off. We have an election here. Back off. End the conflict. Wrap it up already. If that happens, then okay, we're done here. Maybe you'll see a little bit of a risk of Netanyahu going off script and saying, oh, Biden pushed me to end the war or back off. That could be a problem, but for the most part, the White House wanted this to be behind them as we head to the election season. What if the other scenario takes place, though? What if Netanyahu gets out of control and it becomes a race of time here? Does Biden win by containing Netanyahu first, or does Netanyahu win by forcing Biden into being involved in a conflict here? Because that's the point of no return. You can't really back off Netanyahu at that point. If the war expands and involves Iran, for that matter, you can't back off. And it appears to me that we're already heading there. What's going on in the Red Sea right now, with vessels being diverted from the Suez Canal to pass through Africa all the way to Europe, increasing energy costs for these ships, insurance costs, and inflation for the consumer because of the risk of the attacks by Houthi rebels in the Red Sea from Yemen. We see the cargo ships and tankers reducing their volume and they're passing through the Suez Canal. That's inflationary, that's an economic problem. It becomes a geopolitical problem if we get this. And we already got it, folks. Headline reads, U.S. sinks 3 ships, kills 10 after Houthi Red Sea attack. Take a look.
Tonight, the most aggressive action yet against the U.S. Navy in the Red Sea since the Israel-Hamas war broke out. The U.S. Defense Department saying 4 boats with Houthi rebels from Yemen firing on U.S. Navy helicopters. Those choppers firing back, sinking 3 of the 4 ships and killing all crew members on board. The 4th boat got away. The incident started when the small boat started firing on the Maersk's Hangzhou vessel. The container ship issuing a distress call and firing back until the Navy arrived. The U.S. Central Command saying the rebels were just feet away from getting on board the merchant ship. The Houthis are an Iranian-backed rebel group which controls large parts of Yemen.
Now, of course, the skirmishes before and the threats, that was okay, but now we're talking about a real risk of a war that the United States and its allies are being dragged into this war, this time around against the Houthi rebels in Yemen. The Houthis are now vowing revenge for U.S. Navy Red Sea killings. Okay, suppose they attack a U.S. ship here. What will be the response? Is it just going to be U.S. conducting some airstrikes in Yemen or doing some sanctions? Or will it be a full-scale military response? Furthermore, we know that the Houthi rebels are sponsored by Iran. Now Iran is deploying its own warship into the Red Sea. We're getting closer and closer now to a real escalation, to a real event here where we strike Iranian assets. After that, it's a point of no return. The United States will be head-to-head against Iran, probably in a proxy war in Yemen, or maybe even worse, a head-to-head fight, U.S., its allies, against Iran. That's the danger, that's the threat. The other option, of course, when you have, historically speaking, in the United States, when we have an ally going rogue and not listening, what do? We overthrow them. So maybe the CIA, the intelligence, national security, whatever, NSA, will contact their colleagues in the Mossad, for example, in Israel, saying, you know what, this guy's a problem, gotta get rid of him. Coup, somebody get rid of him already before this thing gets out of hand and we have a regional war. What do I think here? I think in the Russia-Ukraine case, Putin will continue to escalate. Why not? He's winning. He can cost Joe Biden the election if he continues to escalate. And I think that Biden will use that as an attacking point against the Republicans, assuming that Trump will be the nominee. In the Israel case, I think that we're now already in a point of no return. We're already in a proxy war against Iran via Yemen. Whether that war is going to escalate a one-to-one fight against Iran, that's the risk, and that's what it appears we're heading into. So with that understanding out of the way, you have to be aware of it because it's going to move the market in a big way. If there's a war against Iran, oil prices will spike dramatically. That's going to change the outlook for the monetary policy. That's going to change the outlook for the market. But you also have to understand it to know that the Biden administration wants to move away from foreign policy as we head closer to November. They don't want to talk about these things. They want to talk about the economy. They think that talking about the economy is a lot better than the foreign policy. Of course, we discussed in details the problem with concentrating on the economy because you have reinflation risk, you have recession risk. By November, if your whole strategy is Bidenomics, we see something blowing up, we are in a recession already, you lost the elections, it's over. So it's a high-stake game here for the Democrats and for Joe Biden's re-election campaign. Question now becomes, what if we are in the summer of 2024 and things are not improving for Joe Biden? The poll numbers are down. Foreign policy is a mess. The economy is a mess. What do you do in this circumstance? Do you just accept defeat? That, okay, Trump is going to get it here, or the Republicans will get it here? Or do you do something different? Do you swap Joe Biden with somebody else here? Sounds crazy, but here's the headline. Joe Biden less popular than the last 4 presidents who failed to win a second term. In other words, the probabilities say that Joe Biden will lose. Well, the Democrats are not going to head into 24 November elections knowing for sure that they're going to lose the elections. To begin with, folks, this is an election year like no other. We have 2 elderly, 2 senile leaders, almost at the 80s, competing for the leadership of this country. To begin with, what if one of them drops? What if somebody dies? Forget about taking Biden out or swapping Trump with somebody else. What if somebody dies here? Let's start with the easy scenario. What if Trump dies? What if Trump is eliminated? What if Trump is banned? Whatever the outcome is, the replacements that we have, Florida's Governor DeSantis and former South Carolina Governor Nikki Haley. You start with DeSantis. He's a clown. Not even sure if he's a human or a robot. He's going to lose 100%. Absent of a recession, he loses. Nikki Haley, that's a disaster. You got to be out of your mind voting for that. You thought that the foreign policy is a mess and we're getting into all of these wars and budget deficit? Wait till you see Nikki Haley. She's owned by Boeing. She's owned by the defense contractors. Might as well vote for Joey B. if that is the case. Here's the complicated scenario. We know that Donald Trump is probably 1 cheeseburger away from having a heart attack. What about Joey B, though? What if he slips on a banana peel, falls in the shower, and dies? Forget about the replacement here. Forget about the Democrats saying, oh, we're going to replace Joe Biden because he wants to spend more time with his family now. Forget about that. Suppose he just dies. What are the options here? You got number 1, of course, VP Kamala Harris. That's a disaster. She's even less popular than Joey B. I'd rather have a cockroach as president than Kamala Harris. So that's a no-go. And that brings, of course, California Governor Kim Jong-un Newsom. Sounds like an easy choice. Biden drops or Biden dies. We say, oh, Kamala Harris wants to be closer to her family now and run for governor of California. And Newsom is going to be the Democratic candidate now. Problem is, you're going to have plenty of testimonies by former Californians like myself who would tell you that Newsom destroyed the state of California. And the last thing we need him to do is destroy this country. So that's a no-go. Well, gee, Maverick, what does that leave us? If Joey B drops or dies, then who's going to replace him here? How about the comeback off? Yeah, baby, she's back. It's going to be Trump versus Hillary once again, or whoever the Republican nominee at the time. I'd leave the result to you. Who's going to win? Who cares at that point? And I know what you're going to say, but what about Michelle Obama at that point? Would she be a candidate here? Michelle Obama wants to be rich. Last thing she wants to do is to be president of the United States. Barack would love to be. If his wife becomes president, he becomes a de facto president, but she's not interested. She wants to get richer, not deal with a poor man's job in the White House. So buckle up, folks. This could be a really, really interesting year here. Anyhow, we spent a lot of time on the outlook for 24, so we have a little time left here to talk about the charts and the outlook here as we head into a new year from a technical standpoint. So let's move on and do some charts here and then wrap it up. We begin with the SPY, the spider. This is a daily chart. What do we see here? Let's look at the indicator before we begin talking about anything else here. You look at the MACD indicator. It appears that we're getting closer to a confirmation. You see the red column on the histogram. We got a false signal before, as I'm highlighting. But the evidence becomes stronger if you combine it with other indicators. So if we look at the RSI, we are now in what it appears to be a negative divergence pattern. So we can see that this signal from the MACD has a higher probability of being correct versus the false signal that we got before when the RSI was actually rising. Number 1. Number 2, you look at the Vortex indicator. I'm going to zoom in a little bit here. On the daily Vortex indicator, you can see that the red line is finding a bottoming formation here, meaning that the bearish momentum has bottomed and it's about to improve now. The bullish momentum in blue is topping. It's showing a topping pattern. And the next thing you know is the bullish indicator in blue moving down, the bearish indicator in red moving higher, and they cross, giving us a confirmation. By that time, of course, it's going to be too late. It's going to be a confirmation. This is why the Vortex is a lagging indicator, not a leading one, when the cross happens. So you have to spot the bottoming process and the topping process for the bullish and the bearish indicators within the Vortex. With that being said, we zoom in the chart itself for the SPY daily chart. Now we have a rising wedge pattern that we talked about in the last video for the members, and we have this rising wedge pattern playing out. That's checkmark number one. But you need more confirmations here. And the second confirmation will be whether the SPY closes below 473 or not. We got a retest on Friday, but we did not close below 473. If we do, that's going to be yet another confirmation. And after that, the last confirmation that we do have a top here will be losing 468 as support. Now, can we see a big pullback at once? A volume-getting-like phenomenon? Sure. Usually these kind of phenomenons begin with a reverse gamma squeeze. We taught the members of this channel how to spot that using the data from the options market. There are days with higher reverse gamma possibility than others. If it happens to be that a big sell order takes place while we have a high risk of a reverse gamma, it could lead into a volume-getting kind of crash and a big pullback. But as a trader, you have to be conservative and you have to take it one step at a time. So what we're showing you right now is a one step at a time confirmation process that we're done with this rally. We have topped or we're about to reverse course. If we look at the SPY weekly chart, we're now at the top of the Bollinger Bands again. We've expanded a little bit. But again, you look at the combination of all of the indicators also topping out here, becoming really extreme. And we've seen this kind of pattern before, the rising wedge pattern. It led to a pullback in the summer. The question now becomes, since we are running against a weekly resistance of the Bollinger Band, having the same look as the rising wedge from the summer, is it going to play out the same way? And if it does, then we have a pullback, a correction in this rally, and we have to follow the targets that we just talked about in the daily chart one step at a time. Of course, the ultimate confirmation of a reversal from a bullish to bearish momentum is if the weekly chart loses the 20 days moving average, the line in white that you see in this chart. We're not there yet. Now we're going to skip the Qs because the NASDAQ has been tracking the SPY. It's been algorithmic trading, so there is nothing new or a huge difference between the charts of the S&P and the NASDAQ. But the IWM, the Russell 2000 for small caps, is usually the leading indicator. And in this chart, on the daily at least, we see a more definitive break of a rising wedge pattern, combined with a confirmation almost on the MACD indicator, a declining RSI, and a rising bearish momentum in the Vortex indicator. If that is the case, then we have support in or around 196 that could also coincide with the 20 days moving average. On the weekly chart, once again, we're outside of the upper boundaries of the Bollinger Bands, showing a reversal candle. The assumption is we should show a confirmation of that reversal candle, pull back, correct the rally a little bit, and then of course we're going to be pretty much enslaved to the data. If the data comes out supporting that rate cuts will be pushed further down the line, then the market will decline more. If we get supporting evidence that inflation is still cooling and we're not seeing any reinflation risk from the data, then we're going to pull back a little bit and then resume going higher again until the evidence changes. If we look at the dollar daily chart, what do we see here? We got really oversold at the lower Bollinger Bands, so you can see that this is pretty much the opposite of what the IWM looks like. The RSI is now improving, so is the MACD, showing a little tiny signal here of a reversal in momentum from bearish to bullish. You look at the Vortex indicator, we are at extreme readings here, and the likelihood is the bullish indicator will improve, the bearish indicator will decline, leading to a rebound in the dollar. We look at the weekly chart, what do we see here in the Dixie? We see that we're really oversold, we're outside of the lower boundaries of the Bollinger Bands this time around. And last time we got a rebound, the assumption is this time around we're getting a rebound too. Rebound in the dollar, not good for equities. It's going to cause a pullback, a correction of some sort. It's also not going to be good for commodities, not good for gold, specifically the old man. So we look at the daily chart here. We got to the top of the Bollinger Bands. We talked about 2080 as resistance. Now we're pulling back a little bit. The momentum is still strong, but if the dollar rebounds, the assumption is we should begin with a retest, the 20 days moving average in white. If that holds, so far so good. If it doesn't hold, we have a problem here. And the same goes for silver. So silver probably a leading indicator for gold, and it already lost the 20 days moving average if we look at the SLV, the silver fund. The RSI is in negative divergence. The MACD is losing momentum, now shifting back into bearish. The Vortex is still showing a risk of both. You see the blue line and the red line improving. So there is risk for both right now, bullish and bearish momentum, but losing the 20 days moving average, and a risk of the dollar rebounding, you gotta be careful with the SLV here. Long-term charts for both gold and silver remain bullish, but it is logical to assume that a rebound in the dollar will lead to a pullback in both. And if the SLV declines, then we can go all the way back to the lower Bollinger Bands again. Likewise, if we look at UK oil, Brent oil, what do we see here? The theory goes if the dollar rebounds, then oil should go down, but recently we've seen oil moving higher along with the dollar and bond yields. Why? Because oil is moving higher based on the probability of inflation. And just a couple of months ago, the probability was high, and both bond yields, the dollar, and crude oil were moving higher. In the last 2 months of the year, we've seen that the dollar, bond yields, and oil moving down, until of course we got some revival in the geopolitical risk. And of course, an assumption by the Fed that they're going to cut rates, a confirmation, which reignited the risk of demand coming back up for oil, and we've seen somewhat of a recovery. But as of late, we have lost or flirting to lose the 20 days moving average here on Brent. We still have a bullish inverse head and shoulder pattern, but it is imperative for oil bulls that we get a rebound by tomorrow's session, because that means that we got to pull back to the 20 days moving average, or we got a positive reaction after that. I think that the geopolitical risk here could support a rebound in oil, despite the fact that the dollar could rebound too. If we look at the chart of the 10-year yield, daily chart, what do we see here? Holding on to support in or around 3.850 basis points. We see that the RSI probably bottomed, improving now. The MACD indicator showing a tiny little green column here in the histogram for the first time since November. Implications? Probably a rebound in the 10-year yield in the month of January. Why? We could speculate about the reasons why, could be just technical in nature, but the most probable scenario is we could get a hot piece of data, retail sales, jobs report, indicating that the battle against inflation is not over just quite yet. And that's going to push rate cut expectations further down the line from March to May, maybe to June, or even the third quarter of this year, but we see a recovery in the 10-year yield. If we look at the weekly chart for the 10-year yield, once again, we're now at the bottom of the Bollinger Bands. We're supposed to find support here, a rebound, a correction, and of course the algorithmic feedback from a correction and a move higher in the 10-year yield is selling the equities market, led by yield-sensitive names. And of course, what comes to mind is the XHB home builders. If we look at the 10-year yield weekly chart, we're at the lower Bollinger Bands, XHB at the upper Bollinger Bands, showing a topping signal here. A rebound in the 10-year yield will lead to a correction in the XHB home builders, so you have to keep an eye for potential juicy trades here. If the 10-year rebounds, you want to pick some puts here against the XHB, KRE, any of these yield-sensitive ETFs will begin to pull back. If we look at the VIX, the volatility index, daily chart, what do we see here? We're still below the 20 days moving average. We're not seeing the need to hedge for 30 days plus, at least not quite yet, and the VIX is struggling to move higher. It's going to require a scare of some sort, reinflation scare, recession scare, systemic risk scare, to increase the demand for hedging for 30 days plus, and that's what causes the VIX to move higher. In the meantime, we've seen the phenomenon of folks hedging by buying the next day's SPY's puts. Cheap, does the job. If it is the day, we got the insurance. If it is not, we take it off with minimal insurance cost. The problem with this behavior is, as we talked before in this program numerous times, it increases the possibility of an inverse gamma squeeze. If we have all of these puts being bought out of the money, hedging for one day, and then in that particular day, we get a huge sell order, the market maker will be forced to dump the market aggressively, to hedge against all of these puts that are being bought or bought the day before out of the money. And that in itself increases the risk of a phenomenon such as volume getting. And that could cause folks to say, okay, this is a really risky behavior in hedging. We need to go back to 30 days plus in buying these puts and these hedges. And that will bring the VIX back. When we look at Apple, the Big Kahuna daily chart, what do we see here? We are below the 20 days moving average again. We did a retest. It was a no-go, so we have confirmation here. Likewise, the MACD is negative, showing negative momentum. The RSI is in negative momentum, negative divergence that is. Vortex indicator now showing a confirmation of bearish momentum. So we have check marks and all. There are no guarantees in life. But for now, all of these indicators are leading to Apple moving back to support. Support would be the lower Bollinger Band that is sitting right now at in or around 190. The precise number is 189.91. I would not be surprised to see a pullback to that number. If we look at Tesla, the souffle and hourly chart, what do we see here? Friday, we got a change of mind by the traders and investors. The day before, they bought Tesla, got it above 258.74. Friday, they decided to dump it. We got some bad news from the souffle. We lost 258.74. We lost 252. Now we're forming a bear flag pattern at the next support of 248.30. Do you short it here? Do you take a short trade at this point? Here's what you have to watch for. Daily chart, look at the 20 days moving average. We have good signs that if we lose the 20, you got a negative momentum in the MACD indicator, negative divergence on the RSI. The Vortex indicator is about to give you a confirmation of bearish momentum. We lose the 20 days moving average. The assumption is we have to go down, retest the lower Bollinger Bands. That's going to be in or around 231.77. Then we have NVIDIA at a weekly chart. What do we see here? Opposite of Tesla, at least in the weekly chart. Above the 20 weeks moving average, check mark. The RSI is improving, check mark. The MACD is about to give us a cross, changing bearish momentum into bullish momentum, check mark. Vortex indicator, look at the blue line. It is moving higher, above the bearish line in red. All the indicators in the weekly chart of NVIDIA saying higher we go until proven otherwise. And of course, the daily chart would be a leading indicator. If we lose the 20 days moving average, then you're going to see that instead of improving from bearish to bullish in the weekly chart, we're actually dipping down more into bearish. But for now, as it looks right now, the risk is for NVIDIA to break above this pattern and challenge the upper Bollinger Bands in the weekly chart and then expand them higher, move above 500. That's the risk for now. We could see a weird phenomenon of rotating from AMD back into NVIDIA. Now, my choice, in my portfolio at least, would be AMD, not NVIDIA. But now that we've had really massive run in AMD on the weekly chart, we're outside of the upper Bollinger Bands. We have seen pullbacks or corrections from this look before. The risk is that AMD will pull back, and maybe we see the money flowing back into NVIDIA. Maybe they pull back together, but for now it appears that AMD is at a higher risk of a pullback than NVIDIA. And if we pull back in AMD, how far down can we go? You have a trading channel, higher highs, and probably higher lows to come. But there is a midline, and that midline would be in or around, let's say, 135, 138. The 20 days moving average right now is sitting at 114. It's going to take its time to climb all the way back to the range, which is the middle of the channel. This is a weekly chart. It's going to take time to materialize. And my hunch is we pull back to that line, and at that time, it's going to coincide with the white line, which is the 20 weeks moving average, and that should offer some support of the chart. If we break that, then we can talk about going all the way down to the lower range of the channel. Then what about tulips? Bitcoin, daily chart, what do we see here? We have seen the lower quality tulips and cryptos pulling back dramatically. Bitcoin has been stable here, and it appears that it got some demand at least for now. It is trading above 43,800, so the risk is to the upside more than it is to the downside. Problem is the Bollinger Bands on the daily chart are really tight, so it's going to require a huge expansion in the volume to expand the Bollinger Bands higher. Otherwise, we're going to be within this tight range here. So be careful of the volatility of being sucked one way or the other. You need to see a break that expands the Bollinger Bands one way or the other. Then you'll follow that momentum. For now, it appears that the upper move, the higher move, is more probable. But we're not there yet. We're not even at the top of the Bollinger Bands yet. So keep an eye here. If we see an expansion of the Bollinger Bands one way or the other, you follow that momentum. Here's a chart for the ticker MARA, which is a crypto miner. Now, we got a lotto ticket trade here on our Discord platform that we entered Thursday. It was the 25 puts. It cost us about $10. By the end of the day of Friday, that lotto ticket gained over 1,500% worth of gains. So we managed to end the year with a bang. Some of us at least. The question now becomes, why did we see such a phenomenon in this stack? We talked about it before. We talked about how we're seeing orders of put options in the money. That is somebody who's long the stack who's hedging, number one. Number two, we've seen that a lot of the lower quality cryptos being bought on leverage, and including this miner, by the way, being bought on leverage, they began to lose value. These lower quality cryptos, they began to lose value in the last 3 to 4 trading days of the year. There was a warning signal here that Mara has been tracking them. If we see losses in those lower quality cryptos, Mara would follow. Likewise, we have seen a lot of puts being bought out of the money, increasing the risk of an inverse gamma squeeze. So when somebody decided to sell during the last day of the year, it was the perfect storm, the perfect setup here for such a huge pullback of double digits in a single day, so a lotto ticket paid a lot. Question now becomes, what is the next MAR? What is the next trade that's going to score such huge gains as a lotto ticket? A lot of you have been talking about ANF, Abercrombie & Fitch, one of the biggest gainers of the year, surpassing NVIDIA's gains. Here's the problem though. The difference between ANF and Mara. Mara happened on the daily chart, meaning there was a stampede at the end there. Using leverage, using options, and what happens is if somebody sells, somebody who already scored gains and they book their profits, all of the chasers who are buying on leverage, well, your broker now has to sell the stock as a hedge because you're borrowing via leverage. So the broker is going to sell ahead of time to prevent you from getting more and more losses since you have leverage. You bought via leverage. If that's happening to multiple accounts, combined with the inverse gamma squeeze risk, then you have a storm of selling here that produces massive losses in a single day. ANF, you're looking at the weekly chart here. This has been a process that's been going on for weeks of short covering, not a stampede as we've seen in Mara. Maybe the last couple of weeks here share a resemblance of what happened with Mara. Maybe we get a decent pullback, and this will be another good lotto ticket. But it's quite different, in my opinion at least, than Mara. If this one pulls back, it might not pull back as big. And the same goes for GoDaddy, weekly chart. A lot of folks are betting that this is going to be the next one, but the setup is quite different here. This is a multi-week process, not a multi-day process. We're not dismissing the fact that it could happen. And if it does, we'll spot it ahead of time. We'll show you what's going on in the options set up here and the risk. And if there's a sell order that triggers the perfect storm, we'll initiate a lotto ticket ahead of time, and hopefully we can hit it as big as the Mara trade. But for now, we'll keep an eye on these charts and deal with them as potential charts for lotto ticket trades, not actual trades where you want to spend a lot of money. Because the implied volatility is really high. If you don't get a big pullback, you're probably going to overpay for the puts. So they have to be dealt with a lotto ticket perspective. Here's one that might not be a lotto ticket, might be an actual trade here. You got Uber. Daily chart, flirting with losing the 20 days moving average in white. We already have negative momentum in the RSI, negative divergence. We have negative momentum in the MACD. We're about to get a confirmation of a negative momentum in the Vortex indicator. So the chart is aligning for a pullback once we lose the 20 days moving average. We're supposed to go down on a revisit of the lower Bollinger Bands at around 58. So we could have a trade here as soon as tomorrow. With that, folks, let's move on to the conclusion of this video. What do we have on the economic calendar this week? We have a lot. And the data will influence Fed rate cut expectations. Now that we're sobering up from the end of the year party, the Santa Claus rally, whatever you want to call it, the data becomes important. And if the data comes out hot, we're going to have a big problem here in the market, perhaps a big correction, because we have to put all of these hopes of interest rate cuts as soon as March, we have to put that to sleep now and push those expectations further down the line. If the data comes out horrific, and I find it hard to see how that's going to happen, but if it does come out horrific, then we might also sober up by the fact that, oh my God, yes, inflation is going down. Yes, we might cut rates, but it's going to be for the wrong reasons. With that in mind, Tuesday, the 2nd of January, we have the S&P manufacturing PMI and we have construction spending data. Wednesday, the 3rd, we have a bunch of Fed zombies speaking, led by Richmond Fed President Tom Barkin. Then we have U.S. jobs opening. This is going to be really important, along with the ISM manufacturing survey. And probably more important than them all are the minutes from the December meeting by the Fed, because that's going to give us more clarity about rate cuts, what they're seeing really. Then Thursday, the 4th, we have the ADP employment report for the private sector of the economy. After that comes initial jobless claims on top of the final survey for U.S. services PMI. And lastly, Friday, the 5th, probably the most important day of the week. We have the U.S. employment report, which is the payrolls. I don't know why they changed the name here. It comes with the unemployment rate, hourly wages, on top of ISM services, factory orders, and another speech by Richmond Fed President Thomas Barkin. With that, folks, hope you enjoyed the show and found it informative. If you did, press the like button, subscribe, leave us a nice comment, and consider joining us as a member. We do more work for the members every day. But with that, folks, once again, Happy New Year. I hope that the new year brings you new wealth and happiness like you've never seen before. But this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Come on.
Is it New Year's yet?
Too close for comfort. Come on.
No, I hate it too. I hate holidays.